Hi, I'm Pattu from freefincal. Today let's talk about Motilal Oswal 5-year G Sec ETF. It's very easy for you to find marketing articles that are found in mainstream media that talk about this ETF as a safer alternative, as a low cost alternative to FDs and all that. Well, that's just complete nonsense. I mean, I don't know. I'm really tired of telling investors that buying a GSEC bond, for example, you can buy a GSEC bond via NSE GoBid. I have talked about this. If you buy a GSEC bond from the NSE portal for retail investors, then that's absolutely safe. There's no problem if you hold it until maturity. If you buy a 5-year GSEC bond and hold it for all the 5 years, every 6 months you will get interest. If the government defaults, then the whole country will be in chaos, so you will not be really worried about your bond default. So there's practically no risk at all. However, if you try and sell that GSEC bond in the middle of that bond tenure, then you will have to face the full market volatility, because every day there will be a demand and supply forces. Sometimes the demand will be more than the supply and vice versa, and therefore the price will oscillate. Longer the duration of the bond, the more will be the fluctuations. For example, you have GSEC bond that are 40 years. If you try and sell a 40-year bond in the market, you will have extreme fluctuations. Sometimes you can get returns like 20-25% from a GSEC sale, or you can get a huge loss as well. On sometimes when you try and buy, there will be a huge premium, or there can be a huge discount. So the longer the maturity of the bond, the more will be the volatility of the bond. Now, if the bond is held by a mutual fund, whether it is an ETF or an index fund or active mutual fund, if the bond is held by the mutual fund, then the everyday NAV will be marked to the market, which means that when the price of the bond in the market increases, the NAV will increase, and vice versa. So you are basically taking on the full market risk when you buy a bond via a ETF or via an index fund or a mutual fund. In addition to that, I don't know why they want to launch bond ETFs unless they want to promote bond ETF trading. Because if you buy an ETF, you have to buy and buy not from the AMC, and you have to sell not to the AMC. You have to do it among a private pool of investors that are participating in the ETF. They're all unit holders in the ETF. Therefore, what will matter for you is not the NAV, but what will matter for you will actually be the price, the daily trading price of the ETF. So you have two layers of risk here. One is the ups and downs of the NAV, and on top of that there will be the price, and that price can be more than the NAV, less than the NAV, and so on. And if there are not many people who are trying to invest or who are trying to buy or sell the ETF, that's what I mean, then you will have difficulty in selling the units. Now today, when you are just buying for 1,000 rupees, 2,000 rupees, it will not make a big difference for you. But imagine if you keep doing this for 15 years, 20 years, you would have accumulated a lot of units, and at that time, let's say you started when you are 20, and after 20 years you will become some old uncle like me, and you will be facing people in the market. All youngsters will be there, and they will be trading only small amounts of money, and you will try to try and sell big amounts, and you will have difficulty doing that. Of course, there will be some person who will always comment, why not we sell directly to the AMC? That's not always possible. Go read the terms and conditions. I don't know what is the term for this, 50,000 units, something like that. So it's not always going to be possible, and therefore you're basically taking on an additional layer of volatility. So now what you see here is the index, that is the underlying index for this ETF, which is the 5-year Nifty G Sec index, and you can see how suddenly in the aftermath of the 2008 crash, the price moved up, and then for some time it was kind of flat, and then it crashed because the rupee became weak in July 2013. Then there was a period of more or less, sideways movement. So you're not going to, it's not like a NAV of a liquid fund which is going to keep moving up. So you're going to have ups and downs. Sometimes you can get spectacular returns, sometimes you can get big losses, sometimes you can go through a period of range bound movement where you don't get any kind of returns, and so on. So let's take, for example, the 5-year return. So you have something like, I forgot the number here. Yeah, 3,596 data points are present in this line here. And that's every data point is a 5-year rolling return CAGR. And you can see here for the index, the maximum return was 11%. The minimum was about 4% or so, and so that's a huge fluctuation. If anybody can tell you that if anybody tells you that this ETF will beat an FD, they are simply lying through their teeth. Nobody knows what return you will get from this ETF or any ETF or any mutual fund, index fund or active fund. Nobody knows what return you will get. It's just silly. Please don't buy this ETF, say, because somebody told you it's safer than a fixed deposit and so on. That's just garbage. That's about what I have to say. Of course, you can use a 5-year G Sec index for a long-term goal. If somebody were to introduce an index fund with a 5-year G Sec index, then that would be perfect for a long-term goal like retirement, etc. Because we have 10-year constant maturity index funds today. We have 10-year constant maturity G Sec bonds. That's the only bond index fund that we have, as far as I know. That is extremely volatile. That will be almost more than twice than volatile than the 5-year gilt. But if there was a 5-year index fund, then it's a much better alternative, in my opinion, for most people, because most people don't understand bond volatility. They just don't appreciate it and they don't know how to exploit it. But that's not the case. We have only an ETF, and therefore please stay away from this ETF. Bye bye.